Hi there. So welcome to Module 6, the Management Accountant's Profit Statement using absorption costing and marginal costing. This is one of the first tasks that you're going to be looking at in relation to management accounting. It is fundamental. The examiner is likely to ask you questions in relation to preparation of the profit statement using either marginal costing, absorption costing, or activity-based costing. In this lesson, what we want to look at is how we can prepare profit statement using the absorption costing principle and the marginal costing principle. In the previous module, I've introduced you to the absorption costing principle, how we treat or deal with absorption costing, and I also mentioned something about marginal costing, but we want to look at how it will really be done in practice. So at the end of this model, you should be able to understand the principles of marginal costing and absorption costing. You should be able to prepare the management accountant's profit statement using both marginal costing and absorption costing, and you should be able to prepare or perform a reconciliation of the management accounting profits, marginal costing profits to absorption costing profits. Then you should be able to state the differences between the two concepts. So basically, let's start with marginal costing. So let's start with marginal costing. What is marginal costing? Marginal costing can be defined as the accounting system in which variable costs are charged to cost units and fixed costs of the period are written off in full against the aggregate contribution. Another name for marginal costing is direct costing, variable costing, or contribution. So what you have to understand is that when we are undertaking marginal costing, we are interested in contribution. Okay? What we want to look out for is contribution. So contribution is going to be your selling price minus the variable cost per unit. So the sales revenue minus total variable cost will give you the contribution. So if you want to get your net profit under marginal costing principle, your net profit is going to be your contribution, okay, minus the fixed cost. So that is why the definition is that it is the accounting system in which the variable costs are charged to the cost unit, but the fixed costs are written off in aggregate, in total, against what? The contribution. So in marginal costing principle, what we are doing is to separate between the fixed cost and then the variable cost. Only the variable cost will be charged against the profit, against the cost of the product or against the cost of sales of the products, but all fixed costs will be written off for the period. Now, why do we need to look at marginal costing? Well, because marginal costing will be used in decision making by organization. Marginal costing will be used for the valuation of the stock of the company, and marginal costing will also be used to provide information to management when they are making planning, when they are making decision making also in the short term. But to take this importantly, this fundamental principle that I just laid down here, as contribution equals selling price minus variable cost, and that net profit is equal to contribution minus fixed cost, you need it because of the rest of the syllables in relation to short-term decision making. So under short-term decision making, where we'll be looking at make or buy decision, shut down decision, accept or reject decision, cost control decision, and then limiting factor decision, among others, relevant costing decision, we will be using the concept of marginal costing. In other words, we'll be dealing with contribution. So fundamentally, you must have it at the back of your mind that marginal costing is going to play a major role in the syllables that we are looking at in relation to management accounting. Now, there are principles of marginal costing. The principles of marginal costing can be looked at as follows: 4 principles. The first one is that the period fixed costs are the same for any volume of output product or for any volume of sales and production. Therefore, by selling an extra item of output or service, the following will happen: revenue will increase by the same sales level, cost will increase by the variable cost per unit, then profit will increase by the amount of contribution earned from the extra item. So the first principle of marginal costing is that the fixed cost is the same for the output. The fixed cost is the same for the given output that is given. 2. Similarly, if the volume of sales fall by one item, the profit will fall by the amount of contribution earned from the item. So the second principle is that if our output reduces, our contribution will reduce by the contribution to be earned on that output, and hence our profit will be reduced by that same contribution that was lost from that output. Third is that profit measurement should therefore be based on an analysis of total contribution. So that's the third principle, that we measure the profit of the organization taking into consideration the total contribution that has been earned by the organization. And then the last one is that when a unit of output is made, the extra cost incurred in its manufacturing are the variable cost of production. Fixed costs are unaffected. So one thing you must understand is that once we are producing more products or once we are rendering more services, the variable cost will increase, yes, but the fixed cost remains the same irrespective of the output level. But for this purpose, let's look at how the profit statement will be prepared under marginal costing. I have already given you an introduction to it, but how do we prepare the profit statement under marginal costing? In the preparation of profit statement under marginal costing, let me work for two cash columns. So what we're going to bring is to bring our sales there. Then we're going to bring with less marginal cost. Marginal cost, or what we call variable cost. Now, please follow me here very well. Please follow me here very well, because understanding the pro forma, it's about 80% for being able to solve the question. So we bring our sales, and after that we bring opening inventory. So if there's only any opening inventory in the question or opening stock, we bring it. Then we bring direct material costs. We bring direct labor cost. Then we bring direct expenses. So usually, I think let me do 3 cash columns so that we take the opening stock. Now, when I add these 3, it gives me the prime cost. Remember that when we add all direct costs, we get prime cost. Now, after getting the prime cost, remember, this direct material, this direct labor, these direct expenses are all variable costs. They are all variable costs. So we add that to the opening inventory, and that will give us normally what we call cost of goods available for sale. But most of the time I don't really like writing it down. But what we do here is to now find, we can still say cost of goods available for sale. Available for sale. Then we less closing stock. This is where the deal is. How do we value closing stock? When we are preparing the profit statement, the closing stock, workings must be done for the closing stock. How do we value closing stock? In the preparation of profit statement using marginal costing, you value closing stock taking into consideration the marginal cost or the total variable cost. You realize that there is no fixed factory overheads that we are bringing here. So even before I less the closing stock, let me bring factory overheads. Okay, so maybe there are some variable factory overheads that we need to bring. We bring it, variable factory. So this figure will be there still, but let me bring that variable factory overheads. So variable factory overheads will be brought. Then this will be the total cost of what? The products. Then from this we less our closing inventory. So the closing inventory is what I was mentioning, that we need to make workings for it. So closing inventory will be based on this marginal cost, okay, the marginal cost, this marginal cost. So this marginal cost here is the closing inventory. We will calculate the closing inventory on that cost. Remember, there is no fixed cost that we are bringing here. So how do we calculate the closing inventory? For instance, if we produced, so production, it's let's say 1,000 units or 10,000 units, and we sold 6,000 units, that means that the output left is 4,000 units. How do we value that 4,000 units? So the closing stock will be calculated as, so this is a very key workings you must note. So closing stock will be calculated as unsold output over production or units produced times this marginal cost. Times this marginal cost. Are you getting the picture well? So your closing inventory value is going to be the unsold output. So in this case, our unsold output will be 4,000 divided by the total production, which is going to be how many units? Which is going to be 10,000, okay? Times whatever figure you get here. That will give you the value for the closing inventory. So when you get a value from the closing inventory, you now get